Something extraordinary just happened in the silver market. Not a rumor, not speculation, not a chart pattern flashing on a screen. This was real, confirmed, and most people completely missed it. Because it didn't happen during normal trading hours. It didn't happen while analysts were watching. It happened while Western markets were asleep. And when markets reopen on Monday, this single event could trigger one of the most violent moves silver has seen in decades. Tonight, I want to explain exactly what happened, why it matters far more than most people realize, and why Monday morning could become a financial trap for anyone who doesn't understand what's really going on beneath the surface. While most of the world was celebrating Christmas, while traders were offline, while screens in New York and London were frozen in time, something very important was happening on the other side of the planet. The Western financial system had gone quiet. The futures exchanges were closed. Liquidity was thin. Algorithms were paused. But the global economy does not sleep, and one market remained wide awake. That market was the Shanghai Gold Exchange, the largest physical precious metals exchange on Earth. This is not a paper market. This is not leverage and promises. This is where real metal changes hands. Bars, weight, delivery. And during that holiday window, with the West silent, Shanghai kept trading. What it revealed shocked everyone paying attention. Silver traded at $82 per ounce. Let that sink in. Not futures, not ETFs, not options. Physical silver. Real metal. At the exact same moment, Western price feeds still showed silver at around $75. That is a $7 difference. And in commodity markets, a gap like that is not noise, it's a warning. What you are seeing on your screen, what analysts were quoting, what broker platforms displayed, was not the real price. It was the paper price. And paper prices only work when people believe in them. That belief is now cracking. That $7 gap represents two completely different markets. One market trades contracts, the other trades reality. One market settles in cash, the other demands delivery. And that gap will close. The only question is how, and who gets crushed in the process. Normally, price discovery happens in New York and London. Comex, LBMA. That's where banks dominate. That's where algorithms suppress volatility. That's where paper silver controls the narrative. But over Christmas, Comex was closed. LBMA was closed. For roughly 36 hours, the Western financial system had no control.
And without interference, without high-frequency trading, without synthetic supply, without futures dumping, the market revealed the truth. The real price of silver, when delivery actually matters, is far higher than the paper price suggests. $82 wasn't speculation, it was discovery. Now comes the dangerous part. When markets reopen Monday, that gap cannot exist. One of two things must happen. Either Western prices surge upward to meet Shanghai, or the paper market fights back hard. If prices gap up, shorts are forced to cover. Margin calls cascade. Buying accelerates. But if banks dump paper contracts aggressively, prices can be smashed down, trapping anyone who bought near the highs. That's the Monday morning trap. And you won't know which outcome is happening until it's already underway. This didn't come out of nowhere. Silver is already up more than 150% this year, the largest move since the late 1970s. But this isn't speculation-driven. This is a supply collapse. Warehouse inventories across Asia are near decade lows. Mints are struggling to source metal. Dealers are on allocation. That means there is simply not enough silver to go around. And unlike investors, industrial buyers cannot wait.
Solar panels need silver. Electric vehicles need silver. AI data centers need silver. This demand is inelastic. They buy at 30, they buy at 50, they buy at 75. At 82, they buy faster. Factories cannot shut down just because silver is expensive. Now add the catalyst most people are ignoring. Starting January 1st, China is implementing strict silver export controls. Only massive producers will be allowed to export. Most refiners won't qualify. The result is simple. Chinese silver stays in China, and China controls roughly 70% of refined silver supply. That changes everything. There's one more warning signal. Silver has entered backwardation in Asia. That means silver available today costs more than silver promised in the future. This almost never happens. It tells you buyers no longer trust future delivery. They want metal now at any price. That's a stress fracture in the system. Futures markets only work when most people settle in cash. If too many demand delivery, the system breaks. We've already seen signs of strain: trading halts, emergency liquidity injections, quiet interventions. When confidence breaks, price discovery moves from paper to physical very fast. This isn't just about silver, it's about currency. When hard assets explode in price, it's usually because paper money is losing trust. Silver doesn't rise in isolation. It rises when the system beneath it weakens. Silver hitting $82 while Western markets were closed is not a headline, it's a message. The physical market just told the paper market what silver actually costs. Now the paper market must respond. Monday morning decides who wins that fight. Understand the risks, know the mechanics, and don't walk blindly into the trap. The next few days may be historic. I'll see you in the next one.